Welcome to the Building and Growing podcast. We're delighted to have Alia Mahmood from Comply Advantage with us today.
Hi, Lucas. It's a pleasure to be here today.
Hey, thank you so much for joining us, Alia, on a lovely sort of spring evening here in London.
We are lucky. We're lucky. The weather has warmed up.
That's right. And look, we're particularly lucky. This is your second speaking engagement of the day. You've been at Innovate Finance today. So we're very pleased that you've got the time and the energy for us.
Anything for you. This is like the Revolut bond.
That's it. This is a Revolut mafia.
It is.
And look, I mean, I think it's a great way to sort of intro. Let me sort of pre-intro you. Alia comes from a compliance background, and I was in a sort of growth background. And I think it's sometimes rare that compliance and growth get on so well.
Absolutely.
But it's very important. So
it is so important, that collaboration and that partnership. And that's what compliance is all about, not being that roadblocker, but actually HSBC had this really right. So I'm just jumping into this.
We'll do your intro in a sec, but jumping into
this. But when I was back in the day, when I was at HSBC, they called like your compliance officers as the stewards of the business.
Wow.
So, we're clearing the way and making it easy for you to grow, for you to scale as a business. And Revolut did it really well. They called us partners, right? So partners with the business, and we measured against that as well.
That's right. Yeah, which is fantastic. Yeah. And, no person in a growth role wants to bring in things that are going to then take up the time of the compliance business and prevent genuine good clients from getting on board.
Absolutely.
And so having that filter and that full alignment is fantastic. Anyway, let's jump into you. So Tell us about yourself, Alia.
So I've, in a previous life before joining Comply Advantage, have been in various risk and compliance roles. Started off at HSBC, like my first kind of compliance gig, really getting a feel of what is financial crime compliance, what is regulatory compliance, and then the kind of overall global banking, commercial banking, those products. And HSBC was a great place to do that kind of learning because you have really good leaders.
Yes.
There's a great kind of diversity involved, and it's not in every tier one, but HSBC had it down really good.
Yeah.
And after 6 years, like close to 6 years, I needed a challenge. So at that point, I moved into an Arab bank, Qatar National Bank, which has a whole different range of risks because you're a foreign branch in the UK, but you're regulated to the UK standards, and you're doing correspondent banking, which is, again, high risk activity. And I was the deputy MLRO, so a lot of responsibility, needing to make sure people were doing things the right way, but also understanding why they have to do it that way. Qatar National Bank was great, but it's that legacy technology. It's all that, when you think of incumbents, it's, just outdated technology, manual processes.
Yes.
I wasn't learning anything new. A point came where I was like, look, tech is the new big thing, digital payments, digital transformation. And I knew I just had to get myself into a place which was kind of tech savvy and tech focused. So Revolut came about after that, which was amazing. That's where we met.
Yeah.
We had our Toastmaster sessions.
That's right. Yeah.
And Revolut was awesome because, as you know, it was hyperscale. It is, I think, even I've seen lots of fintechs, and they're doing great things, but they're not as transformative as Revolut was back, 8 years ago when they started out. Like really just tapping into those unmet customer needs that even a consumer didn't know that they had when it came to managing their money. And when you're in a risk and compliance function in kind of that hyperscale startup, which is now kind of like, super app Revolut, you need to just respond so quick to things. It's like, you've seen it yourself, products are coming out, product governance is happening, but at the same time, you're doing your monitoring and testing. And it was great, but a point does come where, again, you need to change.
Yes,
and I'm always one where when I get comfortable, I need to move out of my comfort zone. And I was really keen. I like the kind of startup vibe. I like being able to support founders on their mission and their journey because I always admire how founders can take like an idea, and it's literally just an idea from inception to actually making it something concrete and have consumers use it and consumers love it.
Indeed.
And I knew that I was good at compliance. So I joined an ethical fintech after Revolut. sole mission for me there, a bit selfish, but hey ho, gotta be selfish in life sometimes. But I wanted to see what that whole authorization process was with the FCA.
Yeah.
How do you get a fintech authorized? How do you get it to become an e-money institution? Build out those financial crime controls from scratch.
Yeah,
and
it's a huge job.
It's a huge job, and it's really fun when you're doing it. But then once it's done, it's the BAU, and the BAU is something which I always found interesting, but it can get just draining as well. And there's always that when it comes to hyper growth organizations, you need resources, you need skilled people, and that's a challenge in the current economy. And once I did that, I was like, okay, they're good to go. They're gonna fly and soar and take off. I needed something that would satisfy me and my needs of making an impact, and that's where Comply Advantage came in.
Fantastic.
And just a little bit about Comply Advantage.
Yeah, please.
So Comply Advantage is a technology company that provides financial crime solutions to fintechs, regulated institutions, financial service companies, and what's special about Comply Advantage is that they play a very key role in making sure your financial system is safe and sound.
Yes.
Because we're helping companies identify those financial crime risks so that they can prevent it. And we do this through our proprietary data, so data around individuals, organizations, screening, transaction monitoring, and I know we're going to get into a bit more of that later on. So for me, it's the impact I can have in an organization like that is just something I'd never get whilst working in a fintech or a financial service company.
Indeed.
But also one thing that RegTech companies lack is that diversity of thought, people from diverse backgrounds who understand the challenges that these type of RegTech products can have on actually excluding people from financial services.
Yes.
So again, for me, it was just making sure that those products don't have bias involved in them. They are not excluding certain customers because you can't get granular when it comes to fuzzy matching, algorithms, or adverse news screening. And I'm enjoying it so far.
Yeah, that's fantastic. And look, I mean, I think one of the things that RegTechs also don't have, or startups in general sometimes don't have, client-side experience, and you've had that both at the legacy companies as well as the fintechs.
Yeah.
And the sort of point that you touched upon in terms of making RegTech more accessible, I think is very interesting, because people don't think about the underbanked necessarily. If they don't have very good pixels on their phone when they're taking a photo of their ID. What effect will that have later on?
Absolutely. And that's so key, because technology needs to be used for good. And you can't just think about your kind of consumer of today. You need to think about the less affluent, the ones that actually need those financial services. Indeed. Not just for buy now, pay later on your, kind of Montclair coat. But those that need to kind of pay bills, they need to get a refrigerator to store food in, because, their refrigerator's broken down. They need to get beds for their children to sleep on. And, with the current kind of economic climate that we're all living in, we're all feeling that pain. Firms are feeling the pain too. So they need RegTech that's affordable. It does the job, it does it well, but also once you've implemented that technology, you have people who are going to support you throughout your kind of relationship with the RegTech provider and vendor. Indeed.
Fantastic. Well, look, let's dive in a level deeper into sort of what RegTech is. And I was thinking about, how best to do this in terms of maybe giving a couple of definitions to people who might not be familiar with the space. We could either go with you listing out, the definitions one by one, or we could do sort of quick elevator pitches where I yell out a keyword and, you shout out a definition.
Okay.
Yeah.
Yeah, let's do it.
All right, let's start off with KYC.
Know your customer. You need to know who you're doing business with.
Mm-hmm. And so for a consumer, that's taking a photo of your ID, doing a little video selfie.
It is proving who you are through documents, and then those documents are going to get independently verified to make sure that they are not forged documents, that you are actually who you say you are. But then in addition to that, KYC also touches upon the risks that you as an individual might have. So
Yes.
are you a resident in a higher risk country? Is the source of your income through a high risk business? And then if you think about your corporate customers and your businesses, the KYB, know your business,
Yes.
that gets a bit more nuanced, because different business types and different industries will have different risks.
Indeed.
You even have different risks when it comes to the kind of legal entity structure. So private limited companies are more riskier than your public limited companies, because they have more transparency, they have more reporting
Yes.
to shareholders and investors. And then limited liability companies are even more riskier because their liability is limited. So
Yes.
again, it's a very interesting, but the key there is you need to know who you're doing business with. You need to know their risks, and you need to accept those risks, and then you need to treat that customer in accordance to how much of a risk they pose for your business.
Yes.
So doing more enhanced due diligence on your higher risk customers, screening them more frequently, monitoring their transactions
Yes.
more frequently.
Indeed, indeed. And look, I mean, we certainly met when I was working on the business side, and, it was absolutely fascinating. I learned a lot, from you and the team in terms of how businesses can be risky, whether it's, let's say from the ownership perspective of having multiple layers of ownerships or trusts wherein you assign ownership to a different individual or an entity.
Yeah.
The fact that some directors may not be resident in the country that you're opening up a bank account in. Politically exposed individuals.
Absolutely.
Yeah.
You're doing my job for me.
Oh yeah, I know. Well, I mean, I'm not giving the definitions, but let's dive into that one.
Okay.
A politically exposed person.
So politically exposed people are individuals that have a public office or a position of power in governments or state-owned bodies.
Yes.
It could even be religious organizations. Or if you think about Rome and the Roman Catholic Church, you can have PEPs involved there. And it's not just the PEP individual themselves. You can have PEP entities, so state-owned entities, state-owned banks, for example, state-owned utility companies, depending on the jurisdiction you're in. And then also their relatives and close associates are also to be treated as a high risk, because essentially when you're speaking of PEPs, and the abbreviation is PEP, like the acronym is PEPs, the risk there is that they could commit offenses of bribery and corruption.
Yes.
So use their kind of position of power to their advantage, but then to the disadvantage of others, or just unfairly use their power to get influence or to do favors for other people. And they're always treated as higher risk, and you really need to understand where their source of funds come from and how they've accumulated their source of wealth, and whether it makes sense that if they're an MP earning, I don't know what the MP salary, I think it was recently increased to maybe 100K or a bit shy of 100K, but they're declaring like close to $1 million. Well, what are those other interests that they have from where this money's coming from?
Yes. And what sort of implications could a financial institution have if they had a politically exposed person who was found to have received some, let's say, questionable funds?
So it would be the facilitating bribery and corruption. So receiving the kind of proceeds of crime from bribery and corruption, potentially not having done enough customer due diligence or enhanced due diligence on that relationship, not asking the right questions. So again, that kind of customer engagement and outreach wasn't there. And essentially you could block the transaction, so you could be quite good in terms of detecting the risk, and you've blocked the transaction. But if you don't block the transaction, then you're just basically allowing the kind of proceeds of crime to flow through. And it could be cross-border payments that are being made. It could be payments made to sanctioned individuals. So the risk can kind of move away from bribery and corruption through to money laundering, through to sanctions invasions, even through to terrorist financing.
Indeed. And these are, I think, key words that we need to dive into. So should we start with transaction monitoring and then go into the heavier pieces after?
All right, let's do that. Let's start with the easy stuff first. So transaction monitoring is where you're literally monitoring your customer's transactional behavior, how much is coming into the account, how much is going out to the account, who's making the payments, who are the beneficiaries of the payments, what countries are those payments going to, and also now if you think about kind of the digital channels through which payments can be made. Well, what are those channels? Are they being made via your mobile? Is it an ATM kind of deposit, cash deposits that are being made? Crypto, is it a virtual asset that's being used? And the key purpose of transaction monitoring is to be able to identify suspicious trends or suspicious activity. But you can only do that if you really understand your customer. So going back to the kind of the importance of KYC and KYB, they're all kind of tied together, kind of like in crochet, like a sweater that you're knitting. Everything needs to be, your processes need to be very tight and interconnected. The kind of requirement from a regulator's perspective is once you've identified that suspicious transaction, you need to report it to the financial intelligence units of your country. So over here, it's the National Crime Agency. And they just recently reported that last year they had 901,000 suspicious activity reports. So you can just imagine. And that was a 23% increase from the year before, 2021 to 2022. So but then even then, I'll tell you a kind of crazy fact, only 1% of money that's laundered through financial systems is detected.
Wow.
And that's only 1%.
That's so little, Shivers, eh?
I know.
Yeah. I mean, I guess it's kind of a KPI for the crime agency that you mentioned to increase that.
Increase it. Well, that's what the economic crime plan is, I guess, that we're hearing the Treasury talk about and our Home Secretary talk about, but what really confounded me was they wanted to recover 1 billion pounds over 10 years.
Far out.
But the cost of money laundering to the UK economy is 100 billion per year.
Wow.
So when you think of that 1 billion, it's like not even a drop in the ocean.
And
also when you think about how much money was lost through fraud during COVID and the pandemic, through all these kind of COVID schemes that were exploited by fraudsters, I think it was around 21 billion.
Shivers,
It's
a huge
more
amount
needs to be done.
Far out.
know.
And I mean, for the banks which helped, well, I don't want to say help facilitate it because I'm sure they didn't do it knowingly, but if they were implicated in it, then it's a reputational sort of risk for them.
It is. It's a reputational risk. It's a fine. They'll have to pay out. And I think your larger kind of traditional banks and your tier ones and tier twos, for them it's almost like the cost of doing business. It's just the way things are, and they can pay these fines, and they can take the reputational hit because if you look at Barclays, even JP Morgan, Deutsche Bank, they've all been in the news, but it's not slowing down the business. They still have customers, but the people it's really going to impact are the fintechs, the startups that are just getting started, still trying to build that consumer confidence and also regulatory confidence.
Indeed. And look, we're going to dive into fintechs in a moment, but let's round off with sanctions.
Now, sanctions is a pain. It's a pain for anyone who has to deal with kind of identifying sanctions risks because they're just constantly evolving. And we've really seen that over kind of the Russia-Ukraine conflict that's been happening. Even recently now, I think the enablers of oligarchs are now being sanctioned. And sanctions are you see, the difference between the way I like to look at it between your financial crime is because you've got that moral imperative that you want to stop criminals gaining from their illicit gains, right? You want to deprive them of the proceeds of crime that they've generated. You also want to stop the crime itself happening because there are victims that are being exploited. Or if you think about environmental crimes, it's our environment, wildlife that's being trafficked and harmed. And sanctions, however, is very politically motivated, right? So there could always be kind of like arbitrage between different governments in terms of what sanctions are unilateral, what sanctions are not. And there's still victims at the end of sanctions as well. When you think of like unilateral sanctions, and we were just talking about Syria before we got started, but the war in Syria was 12 years ago, and that country is still under unilateral sanctions. And I was reading a report by the United Nations that were actually saying we need to lift these sanctions because 90% of the population now in Syria live below the poverty line. And so there is a direct impact of sanctions as well. But for financial institutions, fintechs, and any business, actually, you don't even need to be in the kind of financial industry space. As long as you're a business, you need to adhere to that. You need to be able to identify sanctioned individuals and potential evasion.
Indeed. And look, two final ones that I've thought of, and I promise, to the audience, we're not just going to do definitions the whole time, but counter-terrorist financing, and then we can round off with ABC.
Yeah, so terrorist financing is, as the name implies, it's financing of terrorist activities. That could be kind of violence. It could also be propaganda, and it comes in various forms. You've got right-wing terrorists. You've got religious-based terrorist groups and organizations, and when it comes to kind of detecting terrorist financing from transactional patterns versus money laundering, it's very different, because in money laundering, you have 3 stages of where you're placing the illicit funds in the financial system. You then layer those funds through different products or transfers in order to obscure the ownership or the true source behind how those funds were generated. And then you kind of integrate it. So, you'll purchase real estate, or you buy some arts and antiques is a great one, and even like luxury watches. You've seen money laundering happening through that. Yes. Terrorist financing, on the other hand, it could be legitimate activities that generate funds for terrorist financing, like crowdfunding, kind of getting together people who have similar ideologies, or if it's hate ideology, having them donate to a so-called legitimate cause through crowdfunding platforms. Yes. And then the purpose is to raise funds and then store those funds until they're going to be used, right? So it's a very different typology than money laundering. And when firms kind of implement transaction monitoring rules, they need to be very cognizant of the differences so they can identify it.
Yes, fantastic. And look, I remember our first conversation ever was on ABC, and what could be, let's say, offered as an incentive to partners, as opposed to what couldn't be. And there are some very sort of red lines that I think anybody interested in working for a fintech should know about.
Yeah. Oh, that's so funny. It takes me back to the Revolut days. So, I mean, because I was the lead for bribery and corruption there. And what you're talking about now is like the gifts and entertainment policies that firms have. I don't remember what the Revolut thresholds were. I try to make them very flexible and ample. But it will vary from firm to firm. So each fintech will have kind of their own, what is suitable for taking a client out for dinner, or when it comes to giving gifts at sports events, or, entertainment or concerts, or even hospitality about flying clients over and then putting them up in a hotel.
Yes.
It will differ between firm to firm. But the idea behind it is you need to declare it. You need, everything should be transparent, especially when it comes to your third parties that you're going to be partnering with or doing business with, because the risk there is that there could be favoritism. There could be some form of sway where you are wining and dining a certain client more than the other to get more favorable rates or more favorable deals. Yes. And the question always does come, and I've had this so many times, well, that's how you do business. And whilst that is true, you still need to kind of be transparent about it. So do business the way you're doing it. And let's say it goes above the threshold, you then seek senior management approval. So you have that kind of senior manager taking that accountability and saying, I'm okay with this. This is a client that we really want to secure, and, we want to treat them well.
Yes. Yeah. Fantastic. And I think it's super interesting because, I remember once, I won't sort of name clients or any companies who I was working for, but I was having a chat with a particular individual. They shut the door and they said, you think my daughter can get an internship there?
And that's it. That's like another kind of incentive. That was a great one you said. And also, if you're thinking of like startups, fintechs trying to enter emerging markets, or any company trying to enter emerging markets, especially the more developing countries, the way you do business there is going to be very different from the way you do business in the UK. So it could be that in countries like that, a kind of grease payment, as they're
the
called.
facilitation
A facilitation payment is normal. But then again, your firm's policies need to prohibit it.
Yes.
And bribery and corruption is one of those areas where that policy of yours is going to be looked at by your third parties when they do due diligence on you. So they're going to want to see you say, we prohibit facilitation payments. At the end of the day, whether they're given or not is a different question, right? Because you've got to do business and you've got to enter a market. And, however that's done, sometimes firms just do it. I guess the risk becomes when you are not being transparent about it. So it's, not declaring it.
Yes.
What you're receiving or what you are giving.
Indeed. Look, fantastic definitions. Thank you so much, Alia.
You're welcome.
So one thing that we've touched upon a lot is the fact that there are so many fintechs out there and, banks as well. So traditional financial institutions, all of them have huge customer bases. They're serving millions. During the pandemic, we saw fintechs in particular on board, thousands and thousands of clients every day. How are financial institutions doing compliance in, let's say, the modern world at scale?
They've got very good RegTech providers like Comply Advantage. But yeah, it's very good technology. And what fintechs do well is that everything's cloud-based.
Yes.
So, either it's Google Cloud or Amazon Web Services. They can deploy rapidly. They can integrate with a RegTech provider that also provides cloud solutions to deploy and implement rapidly.
Yes.
And everything happens in real time. But you need technology and infrastructure that supports that. And then also you need skills. So you need people on the ground that are going to be able to kind of manage the alerts and from screening, your customer screening, your transaction monitoring screening. But then also tech companies are a really better place than your traditional banks because they can build in that machine learning and artificial intelligence if a RegTech's not providing it to them to automate all those kind of lower, level manual tasks, which do take up a lot of time.
Yes.
And, that's the key to scaling and onboarding lots of customers. You need really good risk identification. You need to make the customer journey frictionless because that's what consumers expect. They want to open an account within seconds. At the same time, you need to do thorough due diligence and be able to kind of automate where you can processes, but then escalate higher risk instances that do require a person, a human, to actually look and make a judgment on.
Yes, indeed. And look, just sort of diving into the point about requiring a human to make a judgment, one of the sort of the first times, or maybe it was, in my early days at Revolut, I realized, if you want to understand compliance, you've kind of got to think about it like a quiz, and you get a score at the end. And, that score is determined by all of the factors that you mentioned before in the definitions part of the podcast, where, it's like, are they living overseas? If it's a company, is it layered ownership? And the higher the score, the more likely it is to get escalated to a human.
Yeah, so. Absolutely. So you're talking about customer risk scoring right there.
Yeah,
it's another definition. So.
I love it.
I know. So customers need to they need to be risk scored. And the factors, like the main factors you look at for risk factors for a customer is, where are they based? Where are they a resident? Even tax residence. What other countries do they have a nexus to? What products are they going to be using with your firm? Are they the higher risk products, or are they kind of your basic debit account or savings accounts? What channels are they using? Are they using the digital channels? How are you onboarding them? Is it a non-face-to-face? So a lot of our kind of fintechs, mobile apps, it's all non-face-to-face.
Yes,
you don't go into a branch and meet someone. Have I covered all of them? I think I have. Yes. Oh, yes. And then, of course, the results from your screening. How can I forget? Results from your screening. So are they a PEP? Are they a politically exposed person? And then your negative news. So you do negative news screening as well.
Indeed.
So what kind of negative news is coming out about that person? Have they been previously charged for a crime? Was that a white-collar crime, or was that kind of a non-financial crime? Were they incarcerated or were they not? Is it kind of meaningful, legitimate negative news, or is it just, I wouldn't say fake news, but is it kind of less risky? These are people's opinions as opposed to an actual charge or conviction against the individual.
Yes.
And all of those factors derive your low, medium, or high customer risk score. And there will be certain customers that automatically kind of get bumped up to a high risk. So politically exposed people, for example, customers resident in high-risk countries. So you could look at the FATF grey listing or the EU list of non-cooperative jurisdictions. All of those will automatically kind of push you up to a high risk.
Yes.
And then the businesses, if you think about businesses, they have the additional risk factor of what type of business is it, what industry are they based in, and then when it comes to countries, it's okay, where are they incorporated versus where do they operate. So you could have like a UK import-export business, but they're actually operating in Africa and is mining. Right?
Yes.
So then that's going to be a more high-risk company than your kind of merchant e-commerce business.
That's right, yeah. And I remember another one was sort of cash-based businesses.
Yes, absolutely, cash intensive.
Yeah, you don't really, I mean, of course you can get a receipt, but you don't know where the money's come from.
Oh, they're
or where
fudging
it's
those
going.
accounts.
Yeah, that's it.
And that adds the extra kind of risk of tax avoidance, tax evasion.
Indeed, yes, yeah. And that's we could dedicate a whole podcast to that one because it's a fascinating. But look, one of the examples you gave just then was in terms of opening an account, digitally on the mobile. And when you think about, let's say, preventing anti-money laundering 20 years ago, people needed to go to the bank branch. They needed to open up an appointment. I mean, this still happens in the UK today with some providers. Whereas particularly if we rewind sort of 3 years ago when fintechs saturated the market, you were able to open up bank accounts with multiple different providers or e-money institutions just by providing your ID in minutes. And then, there are particular thresholds which, let's say, if you do a transaction of more than £10,000, it might raise a flag. But people were able to open up multiple accounts and then make small value transactions in a much faster time period than 20 years earlier when they had to go to the bank with all of their documents.
Absolutely.
What's your view on sort of how that impacted anti-money laundering?
It just increases the risk. It's increased the risk for fintechs, and it's not even just about the way consumers are kind of making transactions. It's the digital payment aspect of it, is that real-time payments that they can just instantaneously move money cross borders even.
Indeed.
And it's what fraudsters are exploiting. So if you think about money mules, for instance, individuals who literally are just given cash to then deposit into their accounts and then kind of like sent over to somebody else, they're always going to kind of do those low value payments, low denominations, because they know what the thresholds are that banks and fintechs set, and they're always, they're tested. They'll do like maybe, below the threshold, maybe tested above the threshold, and come up with a rationale for where that money has come from. Yes. Sometimes they'll have so-called legitimate businesses, and they'll say, well, it's, come from my business, especially if it's a cash-intensive business.
Yeah, indeed.
And it's just, the risks are increasing, especially when it comes to fraud. And I think that, that has been recognized specifically especially in the UK. You've got like fraud now being classified as a national security threat.
Yes.
And it costs fintechs and firms themselves a lot of money, because you do have to then refund customers based on what type of fraud it was.
Oh, wow.
So, if it's, an authorized push payment fraud, for instance, you'll have refunds and chargebacks that you need to fulfill.
Wow.
And it varies. The US is not so much that you need to refund your customers, but definitely within the UK and EU it is.
Yeah, and that can be very costly for the banks.
Especially when you think about fintechs, they just don't have that money to be giving out.
That's right, yeah. And I mean, it's tragic as well, for people who may lose their life savings. I mean, we're talking about, oh no, the poor bank has to pay out the money, but actually, for the individuals involved, it's very, very sad. Yeah.
So that's a great point you picked up, because we're now talking about fraud perpetrators.
Yes.
Yeah, the ones who are perpetrating the fraud, and then the victims, and Yeah, because risk and compliance aren't, I always think, the worst. I was thinking of it from the kind of perpetrator angle, where you're having fraudsters as your customers that are
Yes.
then making bogus kind of refund chargeback claims. You're then
Yeah.
having to pay it out. And it's true when you think of it from the angle of a victim, especially the romance scams, where there are large, significant sums of money that are being
Yeah.
paid out, not like small, low value payments. That's a victim that has impact on them, not just financial but also like emotional.
Yeah, indeed. And look, I mean, we're talking about some pretty tragic stories. I mean, have there been any sort of funny compliance stories that you're able to share?
Oh, there's so many. I don't think I can share them.
Yeah.
There are a lot of good humorous ones, and I think the kind of win you feel is, when you are in a compliance in a financial service institution, when you are actually identifying those suspicious transactions, or
Yes.
you've actually identified a fraudster trying to open an account on your platform,
Indeed.
and you know that your systems are working, you know that your controls are working. Like, that's a good feeling,
Yes,
and
indeed.
that's
Yeah.
where you're like, yes, what I do is worth something.
Yeah.
And then from, if you're on a vendor side, and for like my role now, where it's, you're a subject matter expert, it's just being able to direct that product strategy so that those products are actually identifying the different risks that different customers face, because it's never going to be a one size fits all.
Yeah. And I think it's a really good moment to sort of transition into talking about the skills that are required for the role. So what type of skills are required for a compliance role?
I'd say only get into it if you're just like, you are thick skinned.
Yes.
Compliance is not a place for sensitivities. It's, you have to have thick skin. You have to be able to be challenged and also challenge other people. You need to make very quick decisions. So the ability to be analytical, logical,
Yes.
back that up by data, because the people you are challenging are going to be senior management, people in C-suite,
Yes.
product directors. And especially if you think about it from a product innovation angle, when you're creating a product that's come from just an idea, you're very precious about it. Like, that is essentially your baby.
Yes.
And to have then someone say, look, no, this is riddled with risks, and we're not going to let you go live with it, feels very personal.
Yeah.
So you have to be able to understand the impact that your decision has on the business, be able to collaborate with them, be able to draw them in. So it's a lot of negotiation skills are required. And these are things that you do kind of pick up along the way in your career. It's not necessary that you have to have them as soon as you get into compliance.
Yeah.
But what you do need to, as soon as you hit the ground and you get into the door of a compliance or risk role, is you need to be analytical. You need to have that data analytics skills,
Yes.
coding skills nowadays as well, because a
Yeah.
lot of the management information, the reports you are generating, you need to run a code in order to get that from the data.
Indeed.
It's not like manual spreadsheets anymore, unless you go work for a foreign bank, which is still kind of doing manual spreadsheets.
Yeah.
And then everything, and you have to be very good at communicating as well. So that's kind of like a skill that's inherent. You have to come into the role with it. And you just, thick-skinned, I can't emphasize enough, because it is a job where you are constantly getting pushback, and
Yes.
it's not easy to have these difficult conversations with people.
And I mean, these sort of roles have huge impacts for the financial institutions, the customers. Is there ever any sort of personal liability that a compliance professional would undertake?
Yes. So if you are, you're the money laundering reporting officer, which is a specific term in the UK, and in the US, it's your BSA reporting officer. That's personal liability right there, because you are personally responsible for ensuring that your firm is identifying, detecting, and preventing financial crime.
Yeah.
And that's a huge responsibility
Yes.
to have on your shoulders. You also, submit annual reports to the regulator. So telling the regulator how many high-risk customers you have, how many PEPs you have on your book, how many customers you've offboarded. So you need to make sure that data you're reporting is accurate. And oftentimes you're relying on other people, who work for you to get you that information.
Indeed.
So again, you need to be an individual who's a leader, who has a team that believes in you around you, a team that you can trust.
Yes.
And I haven't seen many cases of MLROs being fined. I think there was one previously, and it was, again, a foreign bank where the MLRO was fined for just kind of significant willful failures and financial control failures. But I think when you are a compliance person anyways, you take that personal liability very seriously, because you also have the senior management regime where executives have personal liability as well for the way business is conducted. But they don't take it that seriously.
That's it. Yeah, I mean, I think, there's always that sort of that culture of it'll be all right.
Exactly.
Don't worry about it. But actually, in life,
don't tell me. Hear no evil, see no evil. I don't know what's happening.
That's right. Yeah, but I think, like everything, the water always catches up. I think is the key thing there. Yeah. And Alia, earlier on in the conversation, you spoke about artificial intelligence. So what role do you see that playing in let's say the RegTech space?
Oh, a very key role, because it's the ability for us to automate certain tasks for our clients. And if you think about it from a screening angle, customers that are low risk, that have kind of cleared all screening, you'd want to be able to kind of just automate their onboarding, not have alerts generated. And even from transaction monitoring, machine learning is really key, because you use historic customer data to build a picture of, okay, how does that customer transact, to then identify what is suspicious or not. And we can go even further, where if you think about all the different crimes, that the different types, and there are 22 different financial crimes that then would lead to money laundering. They all have different typologies. So you can use machine learning and artificial intelligence to build out detectors, so that when you are monitoring transactions, if they meet specific typologies or trends of a crime, you can then identify clients that, this is not just money laundering, but this is potentially human trafficking, and this is potential sexual exploitation. And in addition to that, you can use machine learning and AI to build out what is known as knowledge graphs. So being able to identify the clusters of individuals or entities that are associated to each other, to identify those organized crime groups. And from a sanctions perspective, you can see how there's a sanctions nexus that might be, 2-3 hops removed, as it's called, and be able to visualize that.
And these are huge amounts of data that we're talking about. And, when it comes to things like organized crime, you can, I certainly would assume that they're using multiple different financial institutions. So do the financial institutions and RegTech providers collaborate together in order to, let's say, color in the picture by combining their information?
No.
Far out.
Because of the data privacy concerns over there. There's not a lot of private or private public sector information sharing as there should be. But then again, we do need to be conscious of data privacy. But if you're in the open banking space and you provide open banking to your customers, then you do have a clearer picture of what's coming in and what's going out, because you can see the different accounts a customer has. So potentially in those situations, you can leverage open banking to be able to see, okay, are there suspicious patterns? Are they clusters of individuals? For an entity itself, you can then identify multiple different customers in your own customer base that might have links together.
Indeed. And I think, from a, let's say a good customer point of view, open banking is actually really beneficial, because if a bank says, hey, like, show us your source of funds, you've got to download a statement, send it to the bank. Whereas with open banking, you just do it with a click. You're never going to get asked, for that info. They might tell us more about this transaction. But as long as you can provide an invoice, or as long as actually the transaction isn't dodgy, you should be all right. So,
absolutely. There are instances where like different financial firms will reach out to each other, but it's usually that reactive, once they've identified suspicious transactions or activity, a compliance department might reach out to the other compliance department if they have a specific financial crime team to understand, okay, this is your customer that's remitted money to us. Can you just confirm, more details about the customer? And that's okay. educate, but that's a very reactive as opposed to a proactive risk identification.
Indeed. Alia, we've covered tons today. It's been absolutely fantastic. I wanted to see if there's any key takeaways that you'd like to share with the audience.
Key takeaways is, put me on the spot. I think the importance of compliance, of course, that it's not a tick box exercise, but it's vital to have embedded financial crime and also compliance risk processes in order to scale, in order to do business and enter emerging markets as well. Indeed. And also use new technologies. And you can't rely on regulators to give you guidance for new types of emerging technologies. Like if you think of Web3, they haven't even touched that. We haven't even scratched the surface, but as a fintech or a startup or a tech company, those are new digital technologies you're going to want to tap into, because that's what the future generation is going to use, and you need to tap into what the future generation will do to have that market, to have them consider you as a viable option. There comes a point where sometimes I think firms and financial services need to be able to educate regulators. So don't be afraid to use emerging technologies. Don't be afraid to analyze the data you have on your customer to build out more personalized products for them that suit their needs, of course. And also don't be afraid to adopt AI and machine learning, because that's the way you're going to scale and build out better products for your customers.
Indeed. Look, Alia, fantastic takeaways. Thank you so much.
Thank you.
Anything else you want to add before we wrap up?
No, I'm good. This was a pleasure.
Excellent. Thanks so much. Fantastic podcast, and great to see you.
It's great to see you.